Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. It's over. The longest government shutdown wrapped. The House extends federal funding through January, and that's it.
They left town again after they voted. They weren't in session for more than 50 days.
Just how happy and healthy are American consumers? Entertainment and vacation giant Disney reported quarterly numbers. CFO Hugh Johnston joins us.
Our consumer is operating in a very healthy way.
On streaming, spending, and leisure.
I think they're being more choiceful, but when it comes to something as significant as a Disney experience, you don't want to cheap out on that. When you're taking the family, you want to go all in.
And Obamacare. 15 years after its passing into law, it remains a political football. We have a wide-ranging conversation with Oscar Health's Mark Bertolini.
50% of American small businesses use the Affordable Care Act. Small businesses are 50% of our GDP. They're the engine of our economy. 27% of farmers use the Affordable Care Act.
Before he ran the exchange-based healthcare company, he was CEO of Aetna, and Bertolini weighs in on these sticky cost questions when it comes to health insurance.
75% of the people in the ACA today are from red states. 100 million Americans don't have access to employer-sponsored health insurance.
Plus, when will flights fly normally again? And where might we go when they do?
Florida's got the weather, no taxes.
Until they don't, but yes, they got the weather.
Yeah, until hurricane season.
It is Thursday, November 13th, 2025. Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernen and Andrew Ross Sorkin. And the Dow closing at a record level once again yesterday. It closed above 48,000 for the first time ever. The government shutdown, even though the government's back open, we're probably not going to be getting the numbers for the latest CPI because the government was closed during those collection weeks, so they never collected the data. It's going to be a while, not just for the airlines, for the government data, lots of other things to kind of get back on track, too.
The yeas are 222, the nays are 209. The bill is passed. The motion is adopted. Without objection, the motion to reconsider is laid on the table.
And it's an honor now to sign this incredible bill and get our country working again. Thank you.
We got the president signing that bill to fund the government, ending what is now the longest shutdown in U.S. history. Emily Wilkins joins us in Washington with the latest. Good morning.
Hey, Andrew. Well, yeah, after 43 days, the government shutdown is now over, longest in history. So that vote last night, you saw all but 2 House Republicans voting to reopen the government. You saw 6 Democrats that crossed the aisle to join them. And then, of course, as you're seeing there, Donald Trump signing that bill last night. And the government's already telling furloughed employees to come back to work today. All of them will be getting the paychecks that they have missed in back pay over the next few days. Now, some of this will depend on how quickly agencies can process the pay. I've heard for some workers who are going to be paid maybe by Friday. Some might not be paid until early next week when the funds hit their bank accounts. We're also waiting to see exactly what the plan is for federal data, because while things like the September jobs report, that was ready to go before the shutdown. But as Becky just mentioned, no one was really collecting the data for the October reports, although of course some could be collected retroactively. We're keeping an eye on what BLS's plans are there now that they've reopened. And on Capitol Hill, the race is now on for lawmakers to see if they can extend those Affordable Care Act premium tax credits before they expire at the end of the year. But many Republicans who I spoke with yesterday, including Speaker Mike Johnson, want to see wider health care reforms.
Am I going to guarantee a vote on ACA unreformed COVID-era subsidies that is just a boondoggle to insurance companies and robs the taxpayer? We got a lot of work to do on that. The Republicans would demand a lot of reforms before anything like that was ever possible, and we have to go through that deliberative process.
After voting last night, lawmakers again left town. They'll be in next week to start catching up on everything they missed in the last 50-some days. And that includes seeing if they can work out those longer-term updated fundings for the many parts of the government that are still under that stopgap funding. And we'll see if they're able to do that and avoid another potential shutdown on January 30th. Guys?
Emily, they left town again after they voted? They weren't in session for more than 50 days.
Yep. They're coming back on Monday. You know, that is a really great question. I think for a lot of them, they weren't exactly sure when they were coming back. And I think it's just for a lot of them, they necessarily weren't expecting it and weren't planning on it. But I think, Becky, there is really a big question because you saw the Senate in this entire time. You saw them move forward with major defense bills. You saw them make progress on crypto. You saw them move a lot of nominations and some legislation. And I think there's a huge question of like, all right, what are all the things that the House planned to do? And some of the members who were back yesterday, they were like, yeah, there are definitely things that we feel are now in the backlog that we're going to have to rush and push to get done. We'll be interested to see if they make some changes for their schedule for the rest of the year to try to get some of those bills in.
Okay.
I meant to tell you guys I'm going to be gone for 50
You're going to be gone for a couple of days?
50.
50 days. And then when you come back, you'll
Look at that smile.
Look at that smile. But nobody's smiling about this, what you're about to talk about.
It is. Air traffic controllers will begin to get paid now that the government shutdown is over. The Department of Transportation and the FAA say flight reductions at dozens of major airports is going to be capped at 6%. It's not going to go to 10 anymore. It was going to rise to 10% by the end of the week. And a DOT release says there has been a rapid decline now in air traffic controller callouts. And Transportation Secretary Sean Duffy said it could take, though, up to a week to start rolling back flight restrictions. They were at 11,000, which was 30% below what was needed to operate what they would consider safely. So they cut back on some of the flights. Hopefully, it happens more quickly. It looks like it is, not going to 10%, but Thanksgiving calls, it's not far off.
It's not. I heard one of the major airline CEOs commenting yesterday saying, I'm sorry, I forget which one it was, but he was saying we should be back on a normal schedule by Thanksgiving.
Yeah.
That's how long it's going to take the airlines to kind of catch up because they canceled so many flights. They have people who have to be rebooked and their own internal operations on some of these things. So nothing bounces back quickly. It's not like you flip a switch and everything goes back to normal.
For a while, Stuckey's is looking good. You know what I mean?
Oh,
driving, a lot of the places. A lot of the places where you stay got a free breakfast, too. Open, waffle maker.
I don't even know what you're talking about. I'm headed to Teterboro after this.
Yeah, I know. You
I don't even know what you're...
You know what that entire area is? You refer to it all the time. Flyover country. You don't even know it, but you don't even know it exists, really, do you? But the book tour.
I've been in a lot of...
The book tour, and it was like, oh my God, it's nice here. You said that yesterday.
There were a lot of places
oh my God,
loved.
you were right dead center, Texas, right?
Oh, Austin, Texas.
Yeah.
I love Austin, Texas.
Yeah.
But that's like the middle of the country. It's a little bit different, a little bit of a oasis for your kind, I think.
Not really. No, it's
not really.
It's very
progressive.
purple. It's very mixed. Absolutely.
Yeah.
It's a combination of all sorts of people. It's really, by the way, you just see by the way, a lot of coastal people have moved there. That's true.
Yeah.
But then there's a lot of Texans there. It's really quite.
Elon was talking about. I mean, people do love it. Great golf course.
Great.
There.
It's great. But by the way, it is growing so fast that there's traffic now. Yeah. There's buildings going up everywhere. I mean, every neighborhood is like changing in front of you, which is probably a great thing and probably a complicated thing for a lot of people.
Apparently, there's a lot of room out there. For expansion in that state, I think.
Yeah, outside city.
Yeah,
outside of the city.
Yeah, outside of the city.
Austin has the State House, too.
Right.
By the way, for them, it really is a temporary job. They're only supposed to be there part of the time, but they're probably clocking as many days as our Congress is, our federal Congress is.
Yeah, we got to go long Texas. I don't know how you can do that. There's no ETF for that, but
there probably is.
You could probably bet something on Polymarket.
Might be an ETF on Texas-related
businesses and industries.
Texas and Florida. Florida's got the weather. No taxes.
Until they don't, but yes, they got the weather.
Until hurricane season.
Yeah.
Right.
Although they
we
got
just
really
went
cold
through
this
hurricane
week, too.
season.
They got really cold, too.
Did you blink?
Complaining. It was in the 30s down in Florida,
right.
and they're not used to
Did anything make landfall? I don't think anything. We had Melissa. That wasn't great.
No, there were people in Florida who were saying, send us pants.
Sports betting player FanDuel partnering with derivatives marketplace CME Group in a predictions market platform that's now set to be released next month. It's going to allow users to bet on financial metrics and sports outcomes, even in places where sports gambling is illegal. Now, prediction markets are federally regulated and considered trading platforms, not gambling platforms. The CEO of FanDuel's parent company telling Jim Kramer that the sports prediction product won't be available in areas where users can access FanDuel sports betting. The state of Nevada disagrees, considers sports prediction markets a form of gambling. That state's gaming control board now announced that FanDuel has surrendered its license to operate in Nevada as a result of all this, and said DraftKings has also agreed to withdraw all pending applications for sports wagering in the state. Neither company offered their online sportsbook in that state, but FanDuel had a license as an information services provider. It's very complicated, a lot of different component parts here, and DraftKings has a license application as described as, quote, inactive at the moment. Now, in a statement, the regulator there calling the foray into sports events contracts unlawful and said this conduct is incompatible with their ability to participate in Nevada's gaming industry. So you have sort of two forms of gambling. You have what used to be the traditional form of gambling, which was state regulated, like Nevada. Now you have this prediction market situation. Some of these guys want this all to come together, which is what I always thought, by the way, would be the ultimate outcome, given that there's so many.
And that's basically what they've just said is like, forget it. We'd rather be able to operate in the predictions market than be able to operate in the state of Nevada.
Exactly. And so this is going to be very complicated very quickly, but it also means I would think that maybe Polymarket, maybe Kalshi, maybe any of these guys either all get merged up, either Polymarket and Kalshi ultimately get into the sports business, gambling business, or the sports gambling guys get into the prediction market business, and it's all one thing. I just can't see how there's like a separation.
Well, it's interesting to watch this trickle down. In Nevada, the traditional casinos are feeling threatened by this, by the sports books, by the FanDuel and the like. They're feeling threatened now by the predictions market. Right. So it's, iterations and steps, and kind of pick your regulator too.
I thought there was zero. Well, I didn't think there was zero, but I thought illegal gambling, no one needs it anymore. You need a bookie.
Right.
Until the recent stories that there's the same four families are still involved in all the.
But that's like rigging it, right?
I know, but what is how much is left?
The bets that you can't make somewhere else?
Bets that are bookies still in business around the country? I never had one. Some of my friends did have one.
My grandfather used to have a bookie.
Yeah.
And we would go, and the guy would literally sit at the bar at lunchtime. I won't say where.
Why?
He's no longer alive. I mean, my grandfather isn't.
Why won't you say which bar?
Well, because who knows? Maybe these people are maybe they're all still in business. Oh yeah, the place is still open. Anyway, and then you'd go.
Tell us off camera.
And there'd be an envelope that would get exchanged one way or the other, depending on what was going on that week. And my grandfather would bet on usually the football games on the weekends.
There must be
Monday or Tuesday there was
I'm sure there's
transfer.
a number. I'm sure there's a number by some Wall Street firm that follows the gaming industry that knows exactly what the percentage of illegal gambling is left. What would you guess? 50% is left? 10%? 80%? What is left from that business?
I don't know.
It's gotta be tiny because you can do everything.
I would think it would be tiny.
You know what? There's not a lot left of pennies.
Not a lot
the last
penny.
one they've minted the last pennies yesterday.
It costs 3.5 cents to make a penny.
3.7 cents to make one. Yeah. So
by the way, it's still
no more pennies. But all of a sudden, seeing this makes me want to go out and hoard pennies.
So you brought that up because that's basically what I'm betting on a lot of these things.
By the way, a nickel costs more than a nickel to make.
Yeah, really?
That might be next. Tens of. Does anyone use cash anyway?
No, that's what I mean. I'm going to have to go find pennies.
They gave me some change the other day. I'm like, keep it. You put it in that little thing. It's like, I don't know what.
Penny.
Yeah.
Penny.
Yeah.
Cheese will be next.
Coming up, Disney feeling the heat from the ongoing dispute with YouTube TV, blacking out the company's channels for some consumers.
We're in the middle of negotiations right now. Things are live, they're happening. Obviously, as we entered the year, we knew this was going to be a challenging battle, and we prepared ourselves for it, and we're ready to go as long as they want to.
Squawk Pod will be right back. Welcome back. This is Squawk Pod.
Up and Andrew, Hugh.
You are watching the one and only Squawk Box right here on CNBC. I'm Andrew Sorkin, along with Joe Kernen and Becky Quick. We got a whole bunch of big stories to tell you about. The longest government shutdown in history. It's finally over, folks. President Trump signing a funding bill, furloughed federal employees headed back to work, or at least we hope, and we'll start getting those missed paychecks.
Let's check on the markets. And we were actually talking. I thought someone wrote the book in 1999, Dow 50,000. It wasn't. We used to talk about it all the time. It was Jim Glassman and some guy named Hassett. It was insane at the time. Dow 36,000.
Not Kevin Hassett.
No, not Kevin Hassett.
Yeah. Dow 36,000.
And a different Jim Glassman. It was Dow 36,000.
What was the time frame that they put it on?
I guess it was not 20. I don't think they actually. That if you're a decent strategist, you never do time and price. But that we thought was crazy, and now 50. And I thought it was 50. I don't know. Someone else wrote a book about Dow 40,000. So here we are. That just to give you some perspective on how far we've come. And the S&P is just below 7,000, which was a lot of people's year-end targets. Then they switched them after April and went back down to 6,000 on Liberation Day or whatever we called it. And there is the 10-year, which is 4.08. Disney might be down a little. That might be why the Dow, sorry, Hugh, but that might be why the Dow is a little bit negative.
Well, we've got him. Disney reporting fourth quarter results just moments ago. We're going to get to walk through all of this. Here's what happened. Earnings, $1.11 a share, 6 cents better than estimates. Revenue coming in at $22.5 billion. Now, that was slightly below expectations. And as Joe mentioned, the man is here, joining us first on CNBC, Hugh Johnston, Disney CFO. Also with us, our own Julia Boorstin. Good morning, good morning, good morning. Okay, so there's a whole bunch of things going on in this earnings report. There's some beats, there's some misses, there's buyback plans, dividends. Let's walk through it.
Yeah, in some ways, good morning. It's, I think, important to take a little bit of a step back. And so how are we doing over a longer period of time? For the year, we delivered 19% EPS growth, which is, I think, pretty darn good. And in the context of the media and entertainment space, I think is very, very good. And over the last 3 years, we've actually delivered 19% EPS growth per year for the last 3 years. So overall, the company's strategy seems to be working awfully well. Diving a little bit deeper into what I think are some of the most important metrics for the analysts. Number one, DTC, terrific quarter. 12.5 million sub ads, 40% operating income growth, hit $1.3 billion this year compared to $100 million last year. And then the experiences business grew revenue 6% and grew operating income 13%. So overall, we're leaving the year with a lot of momentum, both on entertainment and on the experiences business. And as a result of that, we guided to double-digit EPS growth for the year, doubled the share repurchase, 50% increase in the dividend. Overall, we feel good about being what I refer to as an earnings compounder. And I think eventually investors are going to get conviction around that as well.
I know everyone's got questions at the table. What was the dividend choice, meaning to do this?
A number of things. Number one, obviously, when you commit to a dividend, that's a commitment forever. So it's awfully hard to cut the dividend unless some dramatic crisis happens. And we wanted to send a signal. Our cash flow is strong, and it's going to be strong for a sustained period of time. Same thing with share repurchase. To double the share repurchase to $7 billion, that's a signal that says, look, we expect cash flow not to be strong just for this year, but for a number of years going forward.
Give us some insight into what's happening in the streaming division. You added more subscribers than expected, but you also had the Charter deal, and you also launched the ESPN app. What are you seeing in terms of putting all your ESPN content on streaming due to the value of the bundle? Yeah, it's actually doing very well in the things that we find most important. Number one, reducing churn, and number two, increasing engagement. If you look at the sub increase in total, as you mentioned, about half of it, and this was expected, was the Charter deal and those wholesale subs. But the other half was retail, and with that retail, over half of that was international, which is strategically quite important for us. And the balance of it was the bundles that we're doing with Disney+. With ESPN, one of the things I think we're most excited about is fully 80% of those new retail subs on ESPN are actually bundled subs, which again should contribute to engagement, should contribute to retention, and frankly make the service more valuable over time. And then in terms of the parks division, can you give a little bit more color to what you're seeing in terms of the health of the consumer? Yeah. Whether it's bookings, the hotel rooms, the consumer spending. Is the consumer resilient? Are they making plans for the holidays and beyond? I think they're being more choiceful, but when it comes to something as significant as a Disney experience, you don't want to cheap out on that. You want to, when you're taking the family, you want to go all in. So a couple of facts on that. Number one, bookings for the first quarter are up 3%. So we feel good that we've got continued momentum there.
Number two, per caps, so the amount spending per head at Walt Disney World was up 5% for the quarter. So again, people are spending. And then number three, cruise ships, despite the fact that we've added a lot of capacity in cruise ships, we're selling out at the same rate that we had been previously. So that added capacity is filling up quickly. So overall experiences, our consumer is operating in a very healthy way.
Hugh, I made a point yesterday. This should be the best time in the world for media companies, I would think. I mean, Dow's at an all-time high. There's a lot of wind at the back of a lot of business in the United States, and it's just not happening. And I made the point that if anyone looked set up for success in media, I mean, all the assets that you have seem to help each other. You build a brand, you put it in a theme park, you have great content from studios, you put it on streaming. All these things work perfectly. Yeah. You're at a $200 billion market cap, and Netflix is 500. Came out of nowhere with only streaming.
Yeah.
What does media look like?
Joe, I think you make a great point. As I just opened with, 19% EPS CAGR for 3 years says to me, we are an earnings compounder and we're a great cash generator. In addition to that, to your point about the Disney ecosystem, let's use Lilo and Stitch as an example. So it was $1 billion movie for it, biggest movie this year, Lilo and Stitch, looking phenomenally good. In addition to that, we put it on the streaming service, had 14 million views in 5 days. Right, so super content.
I mean, you're making a great case, but my point was, why is it down from much higher levels?
Yeah, you have to take out.
Is it mispriced, the stock?
I believe it's underpriced. I really do. I believe investors are going to build conviction in it over time, and we actually see some investors doing that right now. But I think we need to continue to prove the case that, you know what, as we go through this transition, we are going to emerge one of the winners. In fact, we're already one of the winners.
So all those other things are additive. They're not a drag on.
No, I actually think quite the opposite. I think that integrated ecosystem works really, really well. This whole idea of splitting up assets and all that, that's when you do what you do when you don't have a great business.
Yeah, well, when you have Netflix is showing everyone, making everyone think differently.
Look, well, they've got a great business too, but they're very narrow, but they're deep on general entertainment. Our strategy is different. We run broad in terms of DTC. We have news, we have sports, we have broad scale entertainment, kids entertainment. Who knows? Ultimately on the service, you may see gaming and things like that as well. So I think it's basically the portal into all things Disney. And with the IP that we have, we're going to monetize it well.
Okay, yesterday we had Tom Rogers on, and he said that this battle that you're in with YouTube right now, the idea that you've stayed off for that long,
right.
And that it hasn't been broken even though we're in football season and all these other things that you would normally see both sides come together and reach a deal over it. He said that shows some of the problems with the legacy broadcasting and how the power has really been diluted. Do you think that's the case? And where do things stand with YouTube right now?
No, I think that's an exaggeration. With all due respect to Tom, I know he founded CNBC, but I do think that's an exaggeration and a bit more than is a reality. We're in the middle of negotiations right now. Things are live, they're happening. Obviously, as we entered the year, we knew this was going to be a challenging battle, and we prepared ourselves for it, and we're ready to go as long as they want to. So,
but I think
beyond that, I'd rather
one of the
not comment, I should imagine.
One of the concerns, I think, is that Google, oddly enough, given how small a piece of their overall business is YouTube, from a leverage perspective, they may not care as much as somebody else.
Yeah.
And so, what does that say? I mean, this is what. You can have leverage if you care a lot, and you can have a lot of leverage if you don't care at all.
Yeah. I think at the end of the day, financially, I understand what you're saying, but this is ultimately about your customers. And right now, YouTube customers are suffering without this critical content for them, right? Sports in the middle of football season is about as important as you can get. So I think from that perspective, we perhaps have some leverage as well, because there are other places people can go to get that sports.
Beyond just the fees involved, there's been discussion that there's other elements to this deal that are sort of in play. Can you speak to that?
I'm just not going to comment on the various elements of the negotiation. It's a negotiation. There's back and forth. They want certain things. Right. We want certain things.
How do you feel? Let me just ask one related thing.
Yeah.
The idea broadly of ingestion.
Yeah.
So in the business, there's a question mark. Right now, you can use the apps to get a lot of content.
Yeah.
But a lot of folks like YouTube, if they're going to they want to sell the whole package, and they would like to ingest, if you will, a lot of the content that's on the direct-to-consumer apps into their own systems? How do you ultimately feel about that longer term?
Yeah, anything that we have, we actually would prefer to run through a lot of our own distribution channels, but that's not just Disney owned as well. So I think we're going to just let the negotiation play out, and we'll make a call on these things as we negotiate.
You, Joe, just compared your market cap to Netflix, and we heard Netflix talk about how they're using AI to cut costs. Paramount Skydance just reported they talked a lot about how they're focusing on tech to cut costs. How are you thinking about AI right now as a driver of potential profitability?
Well, it's a big deal for us across a variety of areas. If you think about it right now, number one is obviously in the DTC service. It just can make you much more capable. Similar to what Netflix is doing, we're going down those same paths. Number two is in our experiences business, both for guest management as well as for cast management. We have the opportunity to leverage AI to become a much better experience for people. Number three is in video production, right? Post-production, design tools, and all of those things. If you think about it, what Walt Disney did literally 100 years ago was he was a technologist, right? The animation he created didn't exist anywhere else, and we've continued that. And then the last piece, of course, is the office, which is what everyone talks about. How can you make your office workers much more efficient? We've got a ton of active initiatives on all of those, and I do think it's going to drive the profitability of the business over time.
Yeah, there's also been a lot of talk in the industry about what Paramount Skydance has been doing in terms of its attempts to acquire Warner Brothers Discovery. How does that all that consolidation impact Disney?
Yeah, it's a great question. I mean, number one, obviously, I don't comment on M&A. That said, if you look at what they're talking about doing, it's really what we did 10 years ago. Whether it was the Fox deal or the Pixar deal or the Lucasfilm deal, bringing more IP into the house is something that we did a good long time ago. As a result of that, we don't really need to participate in these things the way some of the other media companies do.
Well, let me ask you a separate related question, which is there's always discussion about what regulators would allow or wouldn't allow in terms of companies that might pursue deals or other deals. There's a view that if David Ellison were to pursue this deal, that the regulators would let that fly through. There's other views that if Brian Roberts, of course, who runs Comcast, were to do a deal, that maybe the president has other views about Brian Roberts or other things that would make a deal tougher. There's questions about if an Amazon were to jump into the fray, for example, and want to buy just the studio business and the streaming business, whether that would be too much consolidation. If, in fact, the regulators were to call you, because they often do in these circumstances, to call the competitors and say, is this good or bad for competition, you would say what?
It's going to depend on who the competitor is. It's going to depend on what the circumstances of a deal are. So in general, look, I'm generally in favor of the market deciding things. That said, we'll see what the specific situation is, and then I'll answer at that point.
Okay. Hugh Johnston, thank you for coming in this morning.
Thank you. Great to be with you guys.
Thank you. And of course, we should mention you are a member of the CNBC CFO Council.
Absolutely.
An illustrious
and have been for a long time.
Yes. Thank you.
Next on Squawk Pod, key tax subsidies connected to Obamacare will expire at year's end, despite the 43-day government shutdown, where they were a sticking point. Healthcare executive Mark Bertolini, CEO of Oscar Health, which manages plans on the Affordable Care Exchanges, weighs in on the power of the market.
Obamacare is a sacred cow. You're never getting rid of it at this point.
All we have to do is evolve it. I don't care what you call it.
And what Americans could do to afford better health.
Nobody's actually put a real plan on the table.
You're listening to Squawk Pod from CNBC. Here's Becky Quick.
Welcome back, everybody. Workers across the nation are in the thick of changing, renewing, or signing up for certain health care plans under the current open enrollment period. Millions of people could and actually very likely will see their insurance premiums rise pretty sharply next year. Joining us right now with insights on the current state of the health insurance industry is Mark Bertolini. He is the CEO of Oscar Health. He's also the new chairman of Verizon and the former chairman and CEO of Aetna, a longtime friend of the show. Mark, thank you for joining us.
Great to be here, Becky. Thanks for inviting me.
We spoke earlier this year when you came in about the problems in the healthcare industry. Nothing changed, nothing happened, but here we are, and we're probably at a moment where it's going to be getting a lot more attention because of what just happened with the government shutdown.
Yes.
There's a lot of confusion out there about premiums going up and how much of that is related to the subsidies ending, how much of that is related to a broken healthcare system that sees inflation far outpace inflation in other arenas?
So what's happening currently in the Affordable Care Act and the enhanced subsidies is that there's a lot of rhetoric about who's getting access to these funds, like $1.5 trillion being spent on illegal immigrants. Not true. 50% of American small businesses use the Affordable Care Act. Small businesses are 50% of our GDP. They're the engine of our economy. 27% of farmers use the Affordable Care Act, and the average farmer makes $60,000 a year gross. Their current premium is $75. With enhanced subsidies, it's going to go up to $300. So $225 a month more out of $60,000 gross is going to pretty much make it difficult for them to do other things like put food on the table, buy seed, do all those other sorts of things that operate their farms. So we're talking about the very basis of our economy and the people that make our economy work. 75% of the people in the ACA today are from red states. 100 million Americans don't have access to employer-sponsored health insurance in this country. And so with all of those characteristics coming together and the high cost of healthcare, drug development, skyrocketing healthcare costs in facilities everywhere else, we have a system built 80 years ago that has built into it inflation. They're not price sensitive to their benefits for the most part. And we built hospitals in every nation in the country, every city and state in the country, so that we created a demand pull into the system that has driven costs up inexorably. Now, what the Affordable Care Act has done that most people don't understand is it's reduced uninsured from 15% to 8%. That has saved $10 billion a year in uncompensated care and charity costs that used to go to hospitals. $10 billion a year. That will reverse to an $80 billion problem over the next 10 years if we start moving that uninsured rate back up.
The answer isn't simply subsidies, though.
No.
There are so many broken things in the system and so many reasons that healthcare costs go up annually with or without the subsidies.
Exactly.
So how do you get at that, and what kind of problem solving can we actually do in the next, 2 months?
So we should create a qualified account, and there has been some concern about fraud, waste, and abuse in the system. There has been some, not as much as people would put on the table. 2.4 million was the number last year. People that are cheating the system. It was really 450,000. At Oscar, it was 27,000 people out of 2.1 million people that we cover. So it was 1.3% when we got down to the actual understanding of each of those people. But let's create a qualified account that is the basis, the doorway to employers, government, or individuals putting money into a qualified account that allows them to spend healthcare their way. So if we put consumers in charge of buying the product, you're going to have an impact on price. Every time consumers get control of what they purchase, they have an effect on the underlying costs and the price of the services they buy.
When you say an HSA account like that, an account where money goes in, I think of a defined benefit going to defined payouts on what you can see with some of these things, much like we did when we got rid of pensions in favor of 401ks. It puts a lot more of the freedom in the hands of the individual buyer, but it also puts a lot more of the potential burden if you mess it up, that there's no safety net there to catch you.
Currently, 95% of people that buy in the individual market today use a broker who have the tools to help them understand which plans they should pick. So I think the first order of business is, do we have the technology and the support to be able to help people pick the right plan? Have money left over after they pick their plan? And turn around and be able to pay their out-of-pocket costs.
Is replacing Obamacare or in addition to Obamacare? Would you use?
I would redo the whole thing. I would use the individual market as a single risk pool. I would use the risk adjustment that's used to allay all the critical costs or catastrophic costs that go through the system. Get spread over many more people than it can happen to any one employer.
This is the Republican holy grail, what they want to try to do. It sounded like you started with making an impassioned plea for Obamacare, but you'd really like to do what Republicans would like to replace it with.
We would like to allow people to get subsidies where they need it. The farmer, the small business owner.
But couldn't they get subsidies and then buy the HSAs?
Yes. Well, no, you put the subsidies into the HSAs.
Right.
You put the employer money from your employer into an HSA.
Into the HSA, right.
Right, and you could put your own money into an HSA.
And then then when you own it, you're not going to be, well, you don't care about what anything costs. You're going to watch very closely what everything costs.
That's exactly right. And 40% of Americans last year, 2 out of 5 Americans, borrowed $74.9 billion from banks to pay their out-of-pocket costs for healthcare. It's a giant suck on the economy. And so if we allow people to buy the network they want, because in the individual market we have narrow networks, I can find my network instead of my employer deciding what it is. I can buy my benefits. If I'm going to have a family, I want better obstetrics.
Right.
If I'm going to have surgery, I buy my benefits using the funds that are in my account, leaving me money to either pay my out-of-pocket costs, depending on the plan design I pick, or to buy other products like dental, vision.
But Mark, Obamacare is a sacred cow. You're never getting rid of it at this point.
All we have to do is evolve it. I don't care what you call it. Just use the concept of the network of the risk pool.
But this is what Republicans have been saying, and people just roll their eyes that that's what they want to do.
Well, nobody's actually put a real plan on the table.
But they say HSA, find your own health, get the middlemen out, get the insurance companies out.
Well, no, the insurance companies have to be there.
They have to be there, but they.
By the way, you guys are working with people on both sides of the aisle.
We are.
To try and bring this about. And I have to say, there are times when I think it is just an expansion of Obamacare. There are times when I think it is an evolution to the HSA program that the Republicans are pushing. But what you're really looking for is every American to be covered. And that's almost universal health care, but with the choice in the hands of the consumer on which one to pick.
But what I'm trying to figure out is where the margin's going to get taken from.
Yeah.
Somebody has to lose in all of this.
So what will happen, just like in automobile sales and in books and in other things people buy online, is that they're going to compress the margins by buying what is valuable to them. They're going to make that value equation.
Right, I understand that, but you're effectively arguing that more competition should compete away margin. But I'm trying to understand where the margin gets competed away most. Meaning, is it ultimately that actually it's going to come out of the hide of the doctors, it's going to come out of the hide of the hospital systems, it's going to come out of the hide of the insurance companies? It can't just be that that more money comes into the system and the same amount of profits
Unless
exist.
consumers are paying more.
And it's not all margin. It's actually inefficiency, gross inefficiency in the system. And if you look at the hospital systems across the country, most of the country, most of them losing money.
Could be somebody's profit in some way.
It could be, right? But you have.
I'm not discounting what you're suggesting. I'm just trying to understand. If we looked at a pie chart of where all the money is.
We've tried everything else to solve this problem, other than put the consumer in charge of what they buy.
Let me ask you one more question that always kind of worries me. I understand the concept of putting it into millions and millions of people so you offset the risk. But if every consumer who is healthy and young opts for the minimum, very bare minimum plan, as I would have done in my 20s, doesn't that just mean that the bigger pool is a pool full of far more expensive people who are therefore going to have to pay much higher premiums? If you're not offsetting the older, but if you're not offsetting the older people who need more help or the families with young, really healthy people, how?
What happens in the market today is it's one big risk pool that gets settled at the end of the year across all the plans. So if a plan has more risk in it, sicker people, they get paid by the plans who don't have any. And so if you even out that risk every year, you socialize the risk across the whole population, you now don't have a problem of underwriting, which is what you're talking about. Sicker people cost more money. Today in a small group, a pregnancy causes a double-digit rate increase the next year. One employee.
For one employee in a employee population of how big?
50.
So everybody has to pay more the next year.
Right. So because you're underwriting that population and it's getting priced. In Michigan, double-digit rate increases for the last 5 years. In Arizona, 28 to 30% rate increases in small businesses today because they're underwriting that pool. And
that has nothing to do with the ACA subsidies, the additional subsidies.
No, it doesn't. And what happens with small employers is they stop offering coverage and they're sending them into the ACA, saying go buy your own product.
That's not good. But all the margins you're talking about, Andrew, every single entity that's going to see that happen is going to resist what you're trying to do.
Of course.
Well, that's why I'm trying to understand how this is all going to happen.
It's not going to happen.
You have to give it to the consumers first. You have to create it, and that creates the movement.
But there's a lot of hands in there.
There's a lot of hands in there. They're taking lots of pieces.
Yeah.
I mean, that's why it's been such an intractable problem for so long.
Right. But we haven't tried this yet. We've tried everything else.
What's the feedback you get from members of Congress when you lobby on either side of the aisle on this?
The way I've been talking about it is, so when Obamacare got started, people thought we're going to ultimately have an individual market for all Americans run by the government. That was sort of the aim, right? You can keep your plan.
Right.
In this model, I'm talking about you keep your network, you keep your plan. Your funding just changes. You separate the funding from the financing from the investment decision.
I mean, employers will love hearing this.
Yeah.
The defined
They do like it.
contribution, they would love hearing that. But again, anything the employer is super excited about makes me think as an employee,
Well, we believe we can save up to 26% on the total cost of an employer group if we do it this way.
Wow.
The other, so if you think about that as the model, ultimately the consumers are going to push it. They're going to push it through. So managing the risk across the whole population is really important. Number one. Number two, having innovation in product. And what happens with employers is they offer 2 or 3 products in one network. I don't get that choice. In the Affordable Care Act, we've limited the number of products we offer because the CMS was concerned about confusing people when buying their product. People are smarter than we think.
Yeah.
And they go to sources to get them. So this is the way to start the process.
It's an intriguing argument. It's an intriguing potential possibility. I've loved talking to you about this over the years, and I hope we get to do a lot more.
Mark, there's an entire political class that viewed the Affordable Care Act as baby steps to single payer.
Right.
They're not going to let you do this.
This would be single payer.
It is in a different way. It's a free market single. It's not a government single payer. It's a free market single payer that would work. Well, that's the opposite of what they want.
Wouldn't it be great if we came to a single, quote unquote, single payer market, either through consumers aggregating their accounts through a qualified account or the government doing it, and all of a sudden this issue is not an issue between Democrats and Republicans anymore.
It's kind of brilliant. I mean,
wouldn't that be the best solution?
It would appeal to everybody, but at the same time, it probably ticks them all off in some way too. Which
everybody's going to have an axe to grind. Everybody's going to hurt, but that's the only way we solve this problem. If we expect everybody to keep going as they're going and have this work, it won't.
Someone's writing in, Mark wants even more government involvement in healthcare. Is that how it would end up in your view? It would be less, wouldn't it?
Less.
The government's still got to fund a lot of it.
But
Medicaid, if you can keep prices down, it wouldn't be as much of a.
So in the Affordable Care Act, $7,500 a year for coverage.
Yeah.
In Medicaid, $8,500 a year in coverage, and I'm rounding it to the nearest $100. In employer-sponsored insurance, $9,400. In Medicaid, Medicare, $14,700.
Right. They don't do it very well, do they?
No, and so if you put all of that into a single pool where people can buy what they need, we're going to have a limit on the bottom where people have to have a qualified health plan, right? Something that is sufficient.
For catastrophic.
We can't have them just doing, these minimum benefit plans that, blow up after you hit a certain number.
Right.
So we have to have a qualified benefit. But if we define that at the state level, we can create these pools at the state level with state-based exchanges where people can buy. Then we can give people the freedom to buy what they want. And by the way, this is a red state kind of issue too, a big red state kind of issue.
Because they have so many people
in the program.
Okay, we have to run, but before we let you go, you are the newly named independent chairman at Verizon for the newly named CEO Dan Schulman.
Yes.
Why the change and what's going to be different at this point?
Verizon has gone from number 1 in market cap, bond ratings, and share to number 3. And the network isn't as differentiated as it used to be, in large part because everybody's been spending money to put these 5G networks in place. So losing 30% share over the last 8 years is an issue. And we have to do something different.
What does that mean?
we have to evaluate underlying cost structure, all those sorts of things. And Dan's working on this, so I'm not going to get in front of Dan's story.
Okay.
But Dan is working on this every day. And we believe that once we have that plan in place, we'll have a good story. The street reacted early on that there's going to be a price war. I think it's less about price war and the value of what we're offering to people through the product. But Dan's coming up with that plan, so I don't want to step on his parade. And he'll be coming forward with it sooner rather than later. And I think, the board needed to act, and we acted.
Mark Bertolini, thank you very much for joining us today.
Thank you.
We
Great to be with you.
Thank you.
You too.
And that is the pod for today. Thanks for listening, whenever and wherever you do. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern to get the smartest takes and analysis from our TV show right into your ears. Follow Squawk Pod wherever you get your podcasts. We'll meet you right back here tomorrow.
We are clear. Thanks, guys.